When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Hi everybody, this is Manoj. I can see a lot of people joining in. I will just wait for a couple of minutes and I'll start my presentation. Thank you for being patient with me. While you're waiting, in your panel you will see that I have uploaded 4 handouts. So please be free to download those handouts. I'll be referring to those handouts in my presentation. All right, I'm ready to begin now. Uh, some of you might have heard my previous presentations, and you would know how it works. Um Basically, I'll finish my topic. At the end, I will ask you to raise questions, and you can see in your panel there is a question box. You can keep on typing those questions which you may have, and after the presentation, those of you can who do not have a question, they want to hang around, they can do so that they can learn from what other people are asking. Now, today's topic is a downsizer contribution. It is very current. Um, these contributions can only be made from 1st of July 2018. So it's going to be pretty exciting on to see the suitability first of all, and the take up on how many people will use this new contribution which has been made available. We're going to talk about who is it for, what is this new downsizer contributions, what are the items which you have to tick off before you put money into super, when you have to contribute into super, and finally, if you are an auditor, how to audit these contributions. Now, for housekeeping audio, this is the best I can do. In your panel, you will see that there is a phone number available. So if you can't hear me properly, I cannot do anything better than what you can hear me at the moment. I've done a sound check, and the sound check allows me to maximize my volume. I cannot do anything better than this. Um, I have uploaded 4 handouts. Uh, in your panel, you will see that there is a box. You can download those panels. And in my presentation, I'll be referring to some of those handouts. Right. Now, finally, just to let you know that this presentation is not legal advice, and neither is it financial advice because contributions can be considered as a product, and of course, self-managed super fund is considered as a financial product. This presentation is only for educational purposes. I am not giving you any legal advice or financial advice or any tax advice. If you do not agree to these uh, disclosures, you should switch off this presentation. Right, now let's start and talk about what are these downsizer contributions and who would it suit. First of all, anyone who is less than 65-year-old cannot make a contribution and call it as a downsizer contribution. So this is the first requirement. Now, these contributions are only to be made after you have sold your own home, and that home should have been owned for 10 years. And I'll give you more details of what own home means and what 10 years means. Now, you must make these contributions within 90 days of sale of your own home. And the maximum which can be contributed is $300,000. So if you sell a property for 200, the maximum you can contribute is 200. That means you may not even meet the maximum amount. But if you sell the property for 500, the maximum you can contribute is 300 and call it as a downsizer contribution. I will talk about total superannuation balance. As we know that you cannot contribute non-concessional contributions into a self-managed super fund once you reach 1.6 million. The best part about this legislation is that downsizer contributions are not considered as a non-concessional contributions. So this is basically a third type of contributions an individual can make into super. We have concessional contributions, then we have non-concessional contributions, and this is the third type. And the third type is the downsizer contribution. I'm going to talk about trust deed requirements and the reporting requirements, what a member must do to contribute into super. Now, the legislation we are looking at is a new section, which is 292-102 of the Income Tax Act. And we should first consider that why this was legislated or what was the purpose behind it. What the government saw is that there were quite a few properties where only one person, they were quite substantial properties, and there was a shortage of properties, and these substantial properties are occupied only by one person or by a couple, and there were many reasons why they were not selling, and one of the reasons were that they could not contribute after selling into super and be in a tax-free environment. So the purpose was basically to help these retirees sitting in massive homes in prime locations and have them available for younger families, larger families who could use those properties. So it was supposed to help both sides, uh, those who are living in them and those who wanted to buy those properties. The problem with the older people not being able to contribute in super is, as we all know, that if you're over 65, you should, when you make a non-concessional contribution, must meet the work test, which is 40 days, 40 hours in a consecutive 30-day period. So that was basically restricting them to sell the property and then move on. So they would rather stay in their big houses because they could not contribute into super. Now, let's talk about making a contribution. Who can make a contribution? Basically, anybody can make a contribution. Um, I can make a contribution for someone, but that person who is receiving this contribution, he has to report to the trustee, and that reporting has to happen in a special form. Now, today, this morning, I looked at ATO. I could not find that form anywhere, so I believe it is somewhere hidden on the ATO website, or it's still not made available. But that form has to be submitted by the member to the trustee of the fund, and that form is some sort of a declaration and a request to the trustee that those contributions should be treated as downsizer contributions. Now, these contributions cannot be concessional contributions. You cannot claim a tax deduction against these contributions. So, uh, and they are not even non-concessional contributions. So this is a new type of a contributions which an individual can make into any fund. Now, there is no maximum age, although you must be 65 years old at the time of making the contribution, but you could be of any age. You could be 90, you could be 100, you could be of any age and still make use of this contribution. Now, uh, there is no work test. As you know, if you are over 65, only mandated, or if once you're over 75, only mandated contributions are allowed. But whereas for downsizer contributions, there is no work test requirement. There is no need for you to prove that you have been working. So if you're auditing the fund and if you see a downsizer contribution, you don't have to worry about whether the person worked or whether the declaration is in place or not. Now, um, the whole idea is that when these seniors sell their own home, uh, the legislators thought that they should be able to earn tax-free income, and that means that if they are able to contribute into super at 300,000 each, they could commence a pension with that money and then pay no tax on income. So that was the whole logic behind these kind of contributions. Now, who can contribute? As I said earlier, you must be 65 years of age at least at the time of making a contributions, and you must have sold a home. And when you say sell, that means the exchange date must be after 1st of July. And this is a once only opportunity. You're not allowed to do it again and again. So it's possible that you have one home, so you're 65, you've owned a home for 10 years, and then you go into another home, and now you're 75. You want to sell your second home, and you've owned the second home for 10 years. So that is not allowed. So it's a once only chance that you are allowed to contribute into super. And the ownership can be can be in one person's name, or it could be tenants in common, or it could be jointly held. But as long as one person in a couple has owned it for 10 years, and in many situations you will find that the property is only one person's name for many reasons, and it could be for death also. So let's say the property was purchased 30, 40 years back. The spouse died and he married again, and the property remained in his name. However, when the property is sold and when a contribution is to be made, the spouse, she's even allowed to make. So, although the property is in his name, but she's also allowed to contribute into super. But the key is that it should be principal place of residence, and the property should be able to be claimed as a principal place of residence, at least for part of the sale amount. And I'm going to discuss that in the next slide, what I mean by part of principal place of residence exemption. but at least it should be able to be claimed. The property must be owned for at least 10 years. So you'll see that in the cases of relationship breakdowns, it's possible that one spouse has owned it and the second spouse comes in. Say the second spouse owned it for only 3 or 4 years or less than 10 years, even then she will qualify because the other spouse has owned it for longer than 10 years. So um, all you have to remember is that at least one spouse out of the two has owned it for 10 years, and that means that both spouses can make a contribution. So this contribution is per person. So a husband can contribute 300,000 and the wife can also contribute 300,000. And as long as one of them had the property for longer than 10 years and that property was at least partly principal place of residence for that one individual. So either spouse must have owned it, and it can be up to 2 hectares, which is 5 acres, and that person must have a legal right. And there could be, like in Canberra and other places, there could be licenses, 100-year license. So they are like tenancy ownership. It's not, and some of those properties, some properties are even on a company title, uh, like a strata company title. So even all those properties uh, are included and they qualify. The other requirement is that the property should be located within Australia. So if there's a migrant who moves in and sells a property which he has owned, say somebody coming in from Germany, but he's owned the principal place of residence overseas, and he sells it, and he's owned that property for 10 years, and he sells it and then he wants to contribute, that would not be allowed because the property was not located in Australia. It cannot be a caravan, it cannot be a household, houseboat, or a mobile phone. So it has to be uh, a house and land, and then the property would qualify. Now, it can be vacant land. Now, there could be a situation where the individual owned land for, say, 8 or 9 years, and then he built a house and he lived in it for a couple of years. So it can be a new building or it could be a rebuild. So let's say he owned the property for 6 years, he knocked the house down, and there was a period where there was no house on that land and it was just a vacant land, and then he rebuilt it. Or there could be a situation where the property was, for part of the period, destroyed due to fire and nobody lived in it for a certain period. The next condition, which is again a very critical one, that individual should be able to qualify under the CGT main resident exemption. So what that means is that if that exemption is partial, that property will qualify. And how that really works is that there could be a property which was being used as principal place of residence, and then it became an investment property. So because that property was principal place of residence for part of the year, the CGT exemption will be available to that person only for part of that year, part of that whole ownership period at the time of sale. But because it is CGT exempt for part of the period, that property will qualify. Now, it does not mean that it has to be a CGT exempt component for CGT exempt residence for both the spouses. If the property is even partial CGT exempt because of main residence exemption for even one of the two spouses, that property will still qualify. Now, as there is a limit on when you can contribute. All contributions must be made within 90 days of the sale. Uh, Again, the contract must be signed after 1st of July. Any properties which are sold in June, like contract signed in June, will not qualify, and the settlement happens in July, will not qualify. So the contract must be signed after 1st of July. And all contributions must be made within 90 days after the change of ownership. What that means is that the ownership, the name change, actually happens at the time of settlement. So if you're auditing a fund and if you see these contributions, you should be asking for a solicitor to provide a letter, and the letter will confirm the settlement date of the sale of that property. Now, multiple contributions are okay. So it's quite possible that the person has received 10% amount and he wants to contribute that money, and the remainder afterwards, that's fine. So, those kind of contributions will be accepted. You can contribute to multiple funds, and if you have a self-managed super fund, and if you have more than one self-managed super fund, you can contribute to multiple funds. But all contributions, the key is that all contributions must be made before 90 days uh, from the settlement date. Now, we all know that once your total superannuation balance reaches 1.6 million, you're not allowed to make any further non-concessional contributions. The best part, or the good thing about the downsizer contribution, is that it does not look at the total superannuation balance of the member. So you could have any amounts in your super, and some people already have more than 1.6 million. I'm not talking about the amount which is going to be in retirement phase, which is 1.6 million. But there are some funds, there are some members, for years they've had $4 or $5 million. So if they sell their own home, they will again be permitted to contribute another 300,000 into super. So we have to ignore the total superannuation balance of the member at the time of making a contribution. But what is very interesting is, um, when you do contribute as a downsizer contribution, the amounts which you contribute gets added to your total superannuation balance. So let's look at an example of someone who has, say, uh, 1.4 million in his super fund, and they contribute 300,000. So at 1.4 million, that person is able to contribute 200,000 non-concessional. So there is a little bit of gap available. But if that person makes a downsizer contribution first, so if you have 1.4 into in super, and if you make a downsizer contribution of 300,000, from 1.4 you will reach 1.7, and now you want to make a non-concessional contribution. Because these downsizer contribution add to total superannuation balance, it's a good idea to make the non-concessional contribution first, and then you contribute downsizer contributions. So you just have to make sure, because what is going to happen is that if you have clients, they will be making contributions in one hit. So it'll be a good idea to ask them to make separate contributions instead of making one big contribution. So this is something which you just uh, have to be careful about. Now, there are other issues you should also watch out on. First of all, is that the trustee should be allowed to accept these contributions. Now, I'm talking about trust deed here. Now, in your handout, I have given you a PDF file, and the PDF file is titled Why You Should Update Your Trust Deed, and this is one of the reasons. So if you have a client who's thinking of making such kind of contributions, you should consider updating your trust deed. We at Trustdeed have recently updated our trust deed, and there are 30 reasons which we have provided why you should consider updating your trust deed. And I'll let you read the document, and then if you have more than 10 funds, we offer some bulk discounts if you update every client which you are looking after. Now, after the contribution is made, the individual has to provide a form, and it's an ATO approved form, and that form should be lodged with the trustee before or on the day the contribution is made. So just remember that if you make several contributions, that means each contribution must come with an approved form, because each contribution has to be declared that it is a downsizer contribution. So if you are an auditor, make sure if there are several contributions, if you see several credits coming in, then all those credits must come along with an approved form. Now, if you are an auditor, I have provided in one of the handouts a declaration. So I've prepared that declaration, and if you use admin documents, you can see that you can even download this declaration from the admin documents. Um, and they get pre-filled by that client, so some of the details can be pre-filled by our automated system. So that form is available on trustdeed admin documents as well. um, One thing you must remember that although these contributions are not non-concessional contributions, and nor are they concessional contributions, but the legislation provides that they should be added to the tax-free component of the member. You know how the concessional contribution and income of the fund go into the taxable component, but these contributions are tax-free contributions for the member. Now, the maximum amount which you can contribute into super as a downsizer contribution is 300,000, and that is per person and not per house or per fund. So it's per person. And this is a once-off opportunity, as I mentioned earlier, and it's only for one home and not for multiple homes, yeah, which I mentioned earlier. Now, you'll say, who would it be suitable to? Because it's quite restrictive, and there's a limit of 300. So, I mean, there'll be some houses in Sydney selling for more than 1 million, and it may not suit all your clients, but it'll suit a very few number of people, and those especially who have less than 1.6 million in super, and they want to commence a pension, and they want to move, downsize, go into a smaller property. Now, one thing you have to remember that these contributions, when they are made into super, they go in the Centrelink asset test, and if they sell their own home, and there is a exemption for own home. So what you are basically doing is you are removing an asset which is exempt under the Centrelink asset test, and you're putting it into the asset test. So you have to be, if you're advising your client to make these contribution, you should be quite wary that if your client is receiving any payments, Centrelink payments, age pension, because of this contribution and because of this sale, um, their pension amounts could be affected. The other thing which you have to be very careful about is for those individuals who have a pension for $1.6 million. So when you do contribute, the retirement phase limits it to the total superannuation balance of 1.6 million. So that means there is a cap amount of which can go into a retirement phase, So any of these contributions, if they go into the accumulation account, that accumulation account will be subject to tax at 15%, and of course capital gain tax proportionate at 10%. Now, one thing you have to be careful that although these contributions are tax-free components, any income earned on these accumulation accounts get added as taxable components. So, if you have a fund which is 100% tax-free, if you make these contributions and these contributions go in accumulation account, any income earned on these accumulation accounts will increase the taxable component of the member. So just be very, very careful. Maybe it could be a good idea to think about having a second fund for your accumulation account, so that, you know, or perhaps roll out some of the money from the existing pension into another self-managed super fund and then contribute it into the original fund. So try to make one fund tax-free if possible for your clients. Okay, now points to note for super fund auditors: how to identify downsizer contributions. That's very easy. You have to just ask the trustees to provide you with the ATO form. Check the date when the contribution was made. That's very, very important. Check the date when the property was settled, and check the date when it was sold. That means the date of contract, whether it was after 1st of July 2018 or not. And one problem is, how would you know whether it was a principal place of residence? And for that, I've provided a declaration in your handouts. So if you download the handout, it'll be a good idea to get an additional security for your audit. That you how would you know that it's a principal place of residence? Is because the trustee themselves, the member themselves, declared that it was so. The other issue is the time limit, the 90-day rule. It'll be a good idea to get the trustee to provide you a solicitor's letter. Now, the other things are whether the trust deed allows it or not. Um, I've spoken about updating the trust deed, and I have a self-interest because, trustdeed.com.au sells super fund trust deed updates, but there has so much which has changed from 1st of July 2017, and if you're using an older deed, I don't know how bad it can be depending on each fund, but I strongly recommend. Now, if some of you are auditors, like me, when I look at a fund, I always look at the legislation and see whether the trust deed really supports each and every strategy which the fund has implemented. So it's like a reverse method, looking at the fund and seeing whether that provision is available in the trust deed or not. So sometimes it's just a good idea to ask the trustees to update the trust deed of the fund. And if you buy from us, that you're guaranteed, because we've got those 30 points listed in that document, that you will be getting a deed which will do the job for you and for the trustees. Now the question is, if the deed at that point of time was not updated, can the trustee say no to those kind of contributions, and can you return the contributions? And the answer is yes. If the trust deed did not permit the trustee to accept those contributions, these contributions must be returned to the member. So again, going back to the original issue of updating the deed. Now, last point, you must make sure that these downsizer contributions are not claimed as a tax deduction by the individual. Now, I am aware that you're not privy as an auditor to look at the individual members' income tax return, but what you can and you can't even ask the administrator or the trustee to provide you the super fund income tax return. But if the financial statements have a calculation for tax, there is tax on there is tax on contributions. So make sure that these contributions uh, are not subject to any tax. Now, some of you would have registered for today's seminar, and last week I was in very bad shape, and today I'm almost recovered, but I'm not fully recovered, and I'm really sorry for postponing it last week. I just couldn't have physically been able to present. Um, just one last thing. What we have today is a very short presentation, but I have put in another presentation on cryptocurrencies, and that is something each and every I've been doing a lot of research, and I think every auditor out there will face a fund. This is very rare, downsizer contribution, and as it is, it's going to happen a year later because all these contributions you'll see them when you're auditing 2018 and 19. But you're very, very likely to see a fund which has invested in cryptocurrencies. So I welcome you to book for that webinar. Um, I will be sending emails out to everyone. That's going to be very interesting because I've started writing that seminar, that whole presentation, and you have to be very, very careful. And I'm thinking that this item will be included in the management letter, and perhaps it will be a good idea for some auditors to even alert the tax office in a contravention report. Now, the contravention report has question number 18 has an area where the tax office is asking the auditor, are you aware of any issue which the super fund is exposed to, and it's likely to affect the future going concern concept of the fund. So this is something. So if you're auditing a fund, if you're issuing an audit report before attending my next presentation, please hold on to it because you have to be really very, very careful looking at funds which have which have invested in cryptocurrencies. I've come to the end of my presentation, so what I'm going to do is I'm going to look at these questions um, and try and answer them. If you have not asked a question, you're more than welcome to hang on and see what other people are talking about. Okay, I've got Michael asking me, are any restriction as to who you can sell the property to? There's no restriction as far as the legislation is concerned. It's basically selling the property which you own for 10 years. So, if you wanted to sell, one spouse wanted to sell to the other spouse, I guess it's a sale. So you can still continue to live in that property, but I guess you have to look at the stamp duty implications. Okay, Mohammed had asked me a question. He says, if one spouse is married to a new partner, can both, I mean the new partner who never owned that property, can contribute as a downsizer contribution? Mohammed, the answer is yes, as long as one spouse has owned the property for 10 years and over. There will be many cases where the other person is not even on the title deed, but as long as one person is on the title deed, the other spouse is entitled to contribute. Okay, next question, Elizabeth. I entered the seminar at 2:47. Can you mention that section as the home being the main resident for one member of the fund? Now, Elizabeth, I've also provided a paper It's a 7 pages. I welcome you to download that from your handout. I uh, um, I have given you some examples also, so that will really help you in determining whether the individual is eligible or not. Okay, I've got another question from Mohammed. I did not understand the tax issue for this contributions. Literally, there is no tax issue when you make a contribution. It is taken as a non-concessional contribution, and these contributions do not pay tax when receipted by the fund. So, Mohammed, if there is any further misunderstanding, you can call me and I can chat with you over the phone. Okay, I've got another question from Mohammed. He says, at the time of contribution, income from this contribution. Okay, so income which is earned by the fund depends on the fund's ECPI, exempt current pension situation. So if the fund is in accumulation phase, it's very unlikely because the member is over 65. Most likely the fund will be in pension phase. So it'll be either partial pension or full pension. So you have to see where the fund is. I have another question from Mohammed again. He says, if one spouse is married to a new partner, can both, I mean, the new partner never own that property? I think I've already answered that question. And that's it. Thank you, everyone. And I'll be stopping this presentation for everyone. I have one more question. Sandra, hi Manoj. I joined the seminar a little late and I was wondering if this was meant to be muted as I could only follow online but no sound. Next time, Sandra, there's a phone number which is provided in your link. When you receive an email, there is a phone number. So if you can't hear me, that's your only option. You have to ring that number, and that's the only way you can get it. You can hear me. Okay, thanks very much. I hope everyone enjoyed today's presentation. Thank you very much.